What if the safest investment on Earth just became a ticking time bomb? In May 2025, Moody shattered a century of confidence, downgrading U.S. debt as interest costs explode past $870 billion a year. China's dumping treasuries, gold's racing toward $4,000. And behind closed doors, Treasury Secretary Bessent just admitted the plan is to outgrow the debt, not by cutting spending, but by letting inflation do the dirty work. Bondholders won't default, they'll just get bled dry. And the global economy? It's already bracing for impact. In May 2025, U.S. Treasury Secretary Scott Bessent admitted that the government's plan to stabilize debt isn't to reduce it, but to inflate it away. We're going to grow GDP faster than debt, he said, pointing to a 6.7% deficit to GDP ratio, higher than any point outside war or recession. But beneath that phrasing is a brutal trade-off. Bondholders may get paid back, but in dollars that purchase significantly less. According to the Bureau of Economic Analysis, real GDP grew just 1.1% in Q1 2025, while CPI inflation rose 4.2% year over year, meaning nominal growth was technically positive, but real returns on bonds have turned negative. Even yields at 5% can't outpace a currency losing purchasing power at twice that rate. Bloomberg reported that the 30-year Treasury yield hit 5.03% after Bessent's remarks, confirming bond markets are already pricing in long-term erosion. If the strategy is growth by inflation, investors are staring down a future where their principal is protected, but their purchasing power is not. And what Bessent isn't saying outright may matter more than what he is. But this strategy only works if the rest of the world still believes in U.S. debt, and that belief just took a direct hit. On May 17, 2025, Moody's downgraded the United States credit rating from AAA to AA1, the final agency to do so. The justification: a sustained surge in government debt and interest payments significantly higher than similarly rated sovereigns. According to the downgrade memo, U.S. interest expenses are projected to consume nearly 30% of federal revenue by 2035, triple today's level. Already, Reuters confirms the U.S. pays $870 billion annually in interest, a 32% increase from 2023. The market responded fast. Gold prices jumped 1.5% to $3,233.50 an ounce, while the dollar index dropped to its lowest point since May 8th. Bessent dismissed the downgrade as lagging, but bondholders aren't waiting. Wall Street's major indexes slid, and foreign buyers paused purchases according to Treasury data released Friday. Bob Haberkorn of RJO Futures called gold a buy-and-hold market in direct response to the downgrade, and Goldman Sachs held its $4,000 price target. Moody's didn't just rate debt, it questioned the credibility of U.S. fiscal leadership. And if credibility breaks, the U.S. could lose more than a rating, especially as its largest lenders begin pulling away. In March 2025, China dropped to the third largest holder of U.S. Treasuries for the first time in 2 decades, reducing its stockpile to $765.4 billion. The UK now holds $779.3 billion, with Japan leading at $1.13 trillion. According to Bloomberg, Beijing didn't just cut holdings, it shortened maturities, trimming long-term exposure while maintaining near-term liquidity. Brad Setter of the Council on Foreign Relations noted China's actions were not a dollar exit, but a duration hedge. I do see good evidence that China is shortening the maturity of its portfolio. This strategic retreat came just weeks before Moody's downgrade, and directly after Trump's April 2nd tariff escalation, which triggered volatility across bond markets. The move may not spell abandonment, but it signals mistrust. If China, with its nearly $1 trillion exposure just 5 years ago, is now de-risking, what signal does that send to smaller economies with less buffer? And what happens if more countries follow suit, not by shouting, but by slowly backing away? Foreign entities now hold 33% of U.S. Treasury debt, over $7.4 trillion out of $22.3 trillion in total marketable debt, per Treasury data. And while some nations like Canada and Belgium slightly increased holdings in March, the broader trend is erosion. The Bloomberg Dollar Spot Index dropped 1.8% in March and 4% in April amid tariff escalation, revealing deepening uncertainty. Goldman Sachs analysts recently warned the exceptionalism premium of U.S. assets is eroding, and their bearish stance suggests further downside risk. Meanwhile, retail investors in the U.S. hold 11% of treasuries, less price-sensitive than central banks, but more likely to panic in a downgrade cycle. Regulatory tiering may keep treasuries technically risk-free on bank balance sheets, but sentiment is shifting. If sovereigns decide not to dump bonds but simply stop buying, issuance outpaces absorption, and yields spike. According to the CBO, a 1-point yield increase raises annual debt service by $240 billion. So the U.S. doesn't need a sell-off to get punished. It just needs silence from its creditors. And silence, historically, is the first stage of exit. Trump's April 2nd tariffs were designed to force trade partners into compliance, but the unintended consequence was a surge in Treasury yields. The 10-year jumped from 3.86% to 4.59% within 3 weeks, per CNBC. The administration briefly paused tariff hikes when bond market volatility spiked, but that reprieve ended with Bessent's May 19th warning: countries that don't negotiate in good faith will face rates above 10%, returning to April levels. But good faith remains undefined. The U.S. demands the removal of VAT taxes, subsidy rollbacks, and currency stabilization from its partners, while continuing domestic tax breaks under the CHIPS Act and maintaining federal subsidies. The inconsistency has undermined Washington's leverage. U.S. retailers like Walmart, operating on thin 2 to 3% margins according to WSJ, are now absorbing tariff costs or passing them to consumers. Meanwhile, government revenues from consumption taxes are projected to decline, contradicting Treasury's own forecast. Bessent's plan leans on nominal GDP growth to mask real contraction, but as supply chains stall, input costs rise, and bond yields spike, the cost of financing the U.S. government becomes its own economic headwind. And if tariffs reset again next quarter, investors may not wait for clarity. U.S. Treasury Secretary Scott Bessent's fiscal strategy hinges on one metric: growing nominal GDP faster than federal debt. But this goal increasingly depends on inflation rather than productivity. According to the Bureau of Economic Analysis, U.S. real GDP grew just 1.1% in Q1 2025, while CPI inflation surged 4.2%, allowing the administration to claim 5.3% nominal growth. The House's $2.8 trillion deficit expansion and the Senate's $6 trillion proposal, both expected to pass, will add roughly $600 billion annually to the national debt over the next decade. Yet the White House projects a mere 0.6% bump in GDP and 800,000 jobs from this spending. Bloomberg reports that the U.S. 10-year Treasury yield sits at 4.48%, but inflation-adjusted returns remain negative, meaning creditors are subsidizing the government's debt load. If nominal growth becomes a function of inflated prices rather than real expansion, then Washington's plan isn't economic growth. It's financial erosion masked as stability. And with Bessent confirming continued borrowing, the real question is how long investors will tolerate shrinking returns before pulling the plug.